So I think right now there's two dynamics to watch out for. First is China. Obviously, we have to have an eye on them. Now, when they say that they are going to try to stem speculation and excessive, trading in commodity markets, I always call bullshit on that, because I don't think that they can, for more than a day or two, hold back the tsunami of commodity flow. So the thing they can do, however, is affect the yuan very directly. And I think that that's something that they may have done today, right? We saw a huge move lower in the yuan today, higher in the dollar. Commodities got wrecked, except for oil, right? So I think that while they realize that they probably can't control the natural flow of commodities, wagging the dollar is probably an option, right? So they may have sort of sold yuan into the markets to depreciate that a little bit, cause the dollar to rally. That takes a lot of air out of the commodity markets. Yeah. So that's one thing to just keep an eye on, right? The second thing is really managing the positioning, because now that, we've been in this, March 2020 last year, the balance sheet trade, knowing that hard assets were going to be the right way to go coming out of that lockdown scenario, going into the green economy that we're trying to, however this is going to go, it's going to go, but we are going to be inhaling commodities at a ferocious pace to try to implement this Green Deal, right? So what we're going to have now is a seesaw between the commodity markets rallying, in a big crowd and getting overcrowded. And then all of a sudden, we're going to see the everything shortage on the cover of Barron's, and we're going to see commodities back off, because that is going to be a sell signal every time. The reality is that they're probably going to continue to find a level and continue to rally, because I feel that the dollar decimation, or the fiat currency decimation, if you will, because it's not always just the dollar that is going on, lends itself just for people to continue to position for an inflationary environment. And, like in some conversations I've had with Grant Williams, we don't think that the big plain vanilla behemoths have changed their portfolios for the next 10 years of inflation yet. So that's sort of the big decision that you have to undertake, is to, like we started off with, is to get your portfolio, focused into those lanes where at least you've got some commodity exposure. Like we said, it's going to be managing the fits and starts. You're going to see commodities blow up to extremes, get way away from their moving averages. And then you're going to see everybody's too long and they'll pull back into the moving averages. People will think the rally is going to end. And then the next thing you know, the dollar will get bombarded again and commodities will catch a bid. So that's kind of the way I've been playing it and the way it's been playing out. But we're in a position right now where we've got China, we've got the Fed talking about potentially, unwinding some of the balance sheet. So all of these things are kind of shaking up the risk complex right now. Yeah. But I think, broadly speaking, what's going on at the Federal Reserve, hard assets are going to have to be the way to go for the next 10 years, if you ask me.